You're running full speed, but the markets are faster. Quasar Markets Live brings the world's top financial minds to you. Everything you need to know in one place. Learn from elite educators and gain a competitive edge, leveling the playing field for you. Join the conversation. Quasar Markets Live.
All right, here we go. Quasar Markets Live. Kevin Green, Schwab Network. How are you, Kevin?
Doing pretty good, Stephen. Went out and did some fishing over the weekend, caught some fish, enjoyed the outdoors. Now back to work, man. How about yourself? How are you doing?
I mean, you got to do it when you see the guys in no longer in suits. They're out there in Jackson Hole, and they're enjoying the mountains, and we got to do some fishing, right?
Yeah, even though I wasn't at Jackson Hole. I wish I was at Jackson Hole. I was down in southern Colorado. But yeah, Jackson Hole, what happened on Friday, obviously a lot of enthusiasm for the markets here. Lack of follow through today, though.
Yeah, I mean, I think a lot of people were excited about the narrative changing with the Fed, especially with Powell saying, okay, we've been wrong. Maybe there's some cracks in the economy. And yeah, we're going to change the narrative and we're going to change the direction. The market exploded to the upside. Everything risk on, and today it's risk off. But people are realizing and waking up that maybe this isn't the best course.
Yeah, and can you blame them? I mean, at the end of the day, what's the setup that we are looking at right now? We are at all-time highs. The Fed is about to cut rates, and probably not for the full right reasons at this point. It's not because we are winning on the inflationary front. It's about the fear of the employment market at this point in time. And once again, we talked about this, I believe, last week. This is almost exactly what we saw this time last year when it came to the economic data and the fact that the Fed kind of started cutting aggressively, and then we started seeing the labor market kind of bounce back here. So on Friday, a couple of different dynamics did take place that I thought was actually very notable. If you look at the S&P 500 market cap weighted X communication services and X technology, it did actually make all-time highs on Friday. So the majority of those gains, if you're looking at it, were the small cap, mid cap companies. It wasn't really the Mag 7, which still did decent, but didn't see that outperformance. So we saw actually a really nice breakout. But today, unfortunately, we saw a reversal. I believe that index was down about almost 1% or so. And now you have kind of this bearish Harami candle that's kind of sitting there. But you did have information technology, at least up until the close, and communication services actually picking up a little bit of steam today. And we're continuing to see this gyration, but this gyration is not coinciding with a breakdown right now. It's a consolidation. And you want to see that as a bull in this market and really kind of hold these key areas of support and resistance. And there's been a very firm channel that has been developing pretty much since May or so that we just basically touched the bottom end of that channel. We bounced right back up. Now we're kind of in the middle of it. So Jackson Hole, yes, phenomenal day. Lack of follow through here today. And the internals kind of looked a little bit weak. The other data point that we want to highlight too, that I want to highlight, I always look at the open interest change for the E-mini S&P 500 futures. I'm a futures trader, and that's a little bit different from the equity traders that are out there. But the futures, you have open interest and you have volume, and you can kind of see who's going new shorts, who's going long, so on and so forth. And when you're looking at the positioning, wasn't that an aggressive adjustment from Thursday to Friday? It was only 20,000 contracts net to the upside on open interest. So it just kind of symbolizes the fact for me, Stephen, that maybe we had some short sellers that were trying to knock that market down, break below these key support areas. We're not able to do so. And that was more of a short covering rally and then risk on in small cap, mid cap, rather than complete broad base, which we would have probably saw some follow through today if that was the case.
Yeah, and as you were talking, my eyes were glued to the Bitcoin now 109.7. We just had a nice little sell off to 109.4 here, about 1,000-point drop again. Is it risk off? I mean, this whole thing seems to be crazy here.
So we are breaking key levels. I look at the Bitcoin futures, breaking that 114,000 level was actually very key. Next area of support, you're sitting at 106,000. give or take a couple of bucks here. So this does look like a breakdown. I'm not saying that this is the top. We have seen this happen before. Actually, in the past, if you kind of look back in May, go into June, and then to July here, you had an inverse head and shoulders pattern, which was able to break that neckline. Are we kind of setting up the same here? I look at Bitcoin and Ethereum and all of these coins and crypto. Look, I'm not a genius when it comes to this stuff. I look at it as a liquidity pool. It's a liquidity gauge that traders can look at and say, okay, are dollars being put to work on the risk parameter side? Yes or no? Is Bitcoin going up? Is Ether going up? Yes. Then we probably have a little bit more risk on sentiment when it comes to the broader market, especially when you're looking at the Qs and vice versa. When I see Bitcoin selling off aggressively like it is, that kind of symbolizes to me that we have some form of a liquidity event taking place right now, at least in the crypto space, that could spill over to the equities. The equities are just waiting for that catalyst. If you think about Monday, Tuesday, Wednesday of last week, everybody had a reason to sell. Everybody was, oh yeah, we're at a top and we're waiting for Jerome Powell and he's going to come out hawkish. And they had every single reason to be bearish. We just did not have that follow through. I think the market's looking for at least that catalyst to try to see a little bit of a pullback here, but you can't deny the technicals for the S&P 500 until we break that key area of support that we've had basically since the May lows here. I still think that you still have to kind of play it to the upside right now. I don't even say it like that. It's innocent until proven guilty, if that makes sense from a technical standpoint.
Absolutely. And, I think one of the things that I have been looking for is where are the catalysts? You've got NVIDIA this week, obviously, will tell a big story. But when I look at it from the perspective of the retail, Target, Walmart, Costco, all those things, none of those things are telling me that the average consumer is happy. Now, I get it. Retail, I get it. Main Street and Wall Street don't always line up. Economics don't always line up with Wall Street. But these events that are happening right now, the geopolitical issues, everything around it, tells you the market shouldn't be this high, and yet the retailers are. Institutions seem to be sitting on the sidelines, right?
I think institutions have definitely put dollars to work. Could there be additional dollars that flow in? That could be the case. Look, that we get to a clear market top, if you will, or one of the signs that I look for is when you see low volume up days on equities, and you start seeing actually an increase in call buying, especially when you're looking at 6 months or out. You start talking about leaps and things of that nature. And you start seeing very big institutional blocks buying leap call options on, say, an NVIDIA, or they buy them on a Microsoft or what have you, rather than actually buying the equity itself. We call those stock replacement strategies, still getting upside potential, but putting a lot less capital, but going out in a little bit of time, maybe doing something that's at the money or even a little bit more in the money because you're buying deltas, and using that stock replacement strategy to get upside exposure, but also not put as much capital to work. That's usually also a decent gauge. I saw some of that activity actually happening here today, not aggressively, but I can tell you on the NVIDIA front, obviously they have earnings as well, but the amount of in the money and at the money calls that are expiring 8 to 12 months out was actually very kind of telling to me. So I think that there's still institutions that have to put money into work. This rotation trade is still going to power through here. And what's interesting about the retail front, when you're talking about, let's say, a Walmart, Target, we don't have that much commentary coming from Costco yet, but they're probably going to be in that same boat. A little bit more of a unique structure there because they're dealing really aggressively with wholesalers in some respects in their business model, and they also have the membership model and things of that nature, right? So it's not just completely dependent on how many people are actually walking in. What you heard and what no one is saying is that Target's feeling the pressure on tariffs, Walmart's feeling the pressure on tariffs. They're choosing not to pass on those costs, especially Walmart.
Yes.
But we know that Walmart can if they wanted to.
What does that mean? When I hear the words, okay, Walmart's not passing on the tariff costs, the margins are lowering, they're not going to raise prices at Walmart. Walmart's not going to eat this, right? They're not going to say, okay, my margins are already thin as they are, I'm not going to continue to eat them. So they pass it on to the retailer, or do they stick it back to the person, the wholesalers, as you said? Who gets stuck with the bill? Somebody does.
Yeah, so usually it's a split. It's not an all or nothing, right, in this whole system. For Walmart, as well as a Costco, they have a little bit more power to kind of adjust prices and also push back on their wholesalers that are selling to them. So what they'll try to do, and what Walmart's strategy is they might have, let's say it's a TV, right?
Yeah.
Maybe the TV is getting tariffed. They might raise that price on the TV a little bit, but they might take a $10 shirt and raise that price from $10 to $11.50.
Yeah.
Right? Where somebody says, oh, it's up $1, it's up $1.50. The consumer may, some consumers, I know some of them in my household are like, I'm not paying that extra $1.50, but some people shrug it off, not even thinking for the fact that that's an 11.5% increase when it comes to that price of that good. And it's a smaller good that they can increase the prices on smaller goods where it's not as noticeable, but those goods are being sold at a higher volume. That's the way that they can actually pass those off. And then they will go to their suppliers and say, look, we need you to slow down the sales, or slow down the inventory here, or we need you to lower prices, one of the two. And those suppliers are going to say, hey, do I lower volume, which is harder to kind of recapture volume if you go through a cycle of 3 months, 4 months, than it is to kind of lower prices. And then Walmart will eat some of that cost. What's good for Walmart right now that Target does not have is the grocery business. And let me tell you, folks, grocery is not a sexy business. You're talking about 4.5% to maybe 6% margins on selling produce and macaroni and on all of this. They don't make that much money on it. But if they are seeing pressure and you're seeing a squeeze from those Target buyers or those that go to Whole Foods or what have you, and they start to go to Walmart, if they can compensate some of the consumer discretionary goods that have higher margins with more of those staples or more of those grocery products and can increase the volume, that's how they can offset it. The last thing, Walmart's was trading at a very expensive multiple. I mean, it was going to be very hard to kind of keep that one up. But there could be a rotation within that space as well, right? Walmart was trading at a very expensive multiple. Dollar Tree, Dollar General, right now, they're getting more expensive. They had a really nice consolidation and base, but they look like they still, if you're looking at it from a charting standpoint, maybe could continue to run. Now, be careful. Dollar General is more consumer discretionary than the name implies nowadays. They changed their mix at COVID-19 at the wrong time to change their mix, and that's why they've had some issues. Dollar Tree has a little bit more when it comes to the pricing power. The problem that you have at Dollar Tree is that the user experience or the customer experience has gone way down, and they cannot keep labor.
Yeah,
that's where they have a lot of churn there.
Let's talk about that. I like that answer. Okay. Over the course of the last, I'd say 4 or 5 days, we've had a rash of new CEOs. We've had mergers and acquisitions, some IPOs, hot IPOs also coming out. But we had a very interesting issue coming out, turned political very quickly. Fairly new CEO, trying to turn the company around. Food's not that great. Cracker Barrel decides to change the logo. You know damn well I'm going to have to ask about a logo change, Kevin Green. What is going on? Explain to me what these new CEOs, what's going on in the world that you and I just aren't picking up on.
Yeah. Okay. So I'm not going to get into the politics of that. I think that's also something that has been, if you notice over the last couple of weeks, and I'll leave it at this, the last couple of weeks, we've had some re-emerging culture wars that I don't even think the majority of
the Epstein thing. I'll say it.
Oh, not even that. Yeah. Well, no, it's just like these random themes that come out of nowhere. I mean, what is it? The other company that had the model and stuff, and it was like, it's being fanned up, but I don't think it's an essential thing. The other thing is marketing, especially for a name like Cracker Barrel that has a legacy brand to it, which probably attracts a significant amount of people to go. You have to have very, very small and subtle changes to your logos, not drastic ones. Burger King's a very good example. If you kind of go on Google and look at the transformation of Burger King's logo for the last 30, 40 years, you don't really think about it subconsciously. You're just like, hey, that's Burger King. But they actually have evolved over time. But it's been very small changes, not a very aggressive change. They had an aggressive change. The marketing wasn't that great. PR, if you can't handle it, you got a crisis within 24 to 48 hours in the media cycle. That's just how it is. And unfortunately, you are seeing a little bit of a backlash here.
But isn't
Let
this
me
a
tell
but isn't this vigilante though? I mean, we saw this with Bud Light, right? Budweiser's same situation, right?
It is, but it's I push back on this and say, look, you could always have you can have your base of customers, but if that base is not expanding, you got to do something different. I'm not saying what Cracker Barrel did was right or wrong. I could care less, right? But there is this balance within within leadership to say, okay, what can we do to kind of continue to drive growth? Are we still able to backfill a segment of our customer population that might be slowing when it comes to traffic within our stores? Because I'm pretty sure that's probably what they were trying to capture, a new audience here. And unfortunately, you did see some backlash. It's unfortunate. What usually happens is that they get a black eye. That black eye can last for, let's say, a year or 2 years or so. And then people move on to the next thing. It's an unfortunate situation. But branding mistakes happen like this, all the time. I'm going to keep it super high level. There was a branding mistake by Coca-Cola, if I'm not mistaken. This is a very long time ago. This wasn't recently. I think they did a branding campaign in Mexico, and they tried to translate exactly their branding here in the United States to their branding in Mexico, and it did not. Right. It did not work. And they had another situation where it's a very key market. They're trying to expand into that market a little bit more, capture some of that market share, and unfortunately, they just didn't hit the mark. That's just how these things work. And unfortunately, they took an L for right now. I will say, though, the Rainbow Trout meal, from a value standpoint at Cracker Barrel, is actually pretty good. I don't eat a lot of the stuff. And they also have like a catfish breakfast thing going now. Yeah, they got a catfish breakfast thing going on. That's really good. But unfortunately, it's a branding error, and they're going to have to do damage control.
Yeah, and when you're going through this time period, it seems to me there's like a crushed time period here where a lot of companies are doing this rebranding thing. How do you modernize something that's historically unable to modernize, right? You've got Coca-Cola and these brands that have been around since way before, 1800s, right? In this case, but you had this time period right now where it just seems like the world just isn't all together right now. Things aren't just geopolitical tariffs. The Fed seems to be uneasy. Everybody's on the edges. Why do the branding now, and why not just wait until the end of when things get better?
Because things never get better.
Okay.
We're always in a crisis, Steven. If you think about time, if you think about think about the last 20 years, we are always in a crisis. It's just that they evolve over time.
Are they faster?
We're always in a crisis.
Are they faster now?
Yeah, we're always messy. We're never clean.
Are they coming faster? Or is it just social media just making it louder and louder and louder?
Yeah, you have social media that can definitely expand, the branding and the messaging. And the first one that can set the tone. And if you got a couple of influencers, boom, you could have something that completely gets out of hand or gets out of control fairly quickly. And that's with everything. And so you never blame a company for trying to rebrand or do something different, because sometimes they have to do so in order to stay afloat. Red Lobster is one of those experiences. Yeah. Red Lobster, look what happened to them. They had the menu, they were a staple in some people's households, 10 years ago, 15 years ago, but they had a menu item, endless bottomless shrimp or whatever. They could not scale that. They were losing money hand over fist, but that was the only way that they were getting traffic. They never really updated their stores or the looks of their stores, and it started becoming something that you always have to backfill a generation. Just because I eat at Cracker Barrel, I'll eat there now, right? But at some point in time, I might evolve. I might have a different diet or something of that nature, right? There's a whole bunch of different things that can happen. What can you do to recapture or capture a new audience? That's always difficult. So it happens with companies all the time. I think Norvo Notice is another one that's kind of very interesting when it comes to the branding as well. You do the Hims deal. Hims is still kind of undercutting your sales reportedly, right? But I'm not making the accusation. You cut that deal. Now what do? You know what I'm saying? It's always going to be chaotic. And what I want to kind of stress though, chaos and uncertainty is what brings risk and premiums in markets, and what brings profitability in markets as well, and risk and even losses at that point. So unfortunate error, but Cracker Barrel fundamentally, if you look at their business, maybe right now in this cycle, it's probably a little bit more difficult. I got to look at the chart, but they are a corridor play. As transportation, freight traffic increases, transportation and consumption for gasoline increases. Guess where their stores at? Their stores are right off the highway, most of them, you know? And so that's how they make their money. So if we do see a cycle where you start to see transportation and freight starting to move a little bit more aggressively here, they are going to be a beneficiary of that. Their stock chart looks, you can overlay that with GDP growth, X data center, and it tells a story. Yeah. And that's what you're kind of looking at.
I have started to coin a new term. I don't know if it's new, but it is new to me, and I've been doing this for almost 35 years. Stayflation. This is where I feel like the companies in general are not replacing older employees because they're keeping them and they're staying. And the younger generation, the newly educated, they're graduates coming into the new workforce, and companies aren't hiring them because AI can replace them. They're going to try to replace the old. They can't replace them. AIs and if you're coming in as a graduate, new employee, that you don't have the same job skills, and AI can easily do those new job skills. So it seems to me that there's this gap of new graduates coming out, and I'm calling it stayflation because they're making the employees stay, and inflation's coming. So here we go, we get a double whammy in these companies. Is that something that I'm thinking up? Is it made up? Is it really happening?
Yeah, it's really happening. If you go back into the late 90s, early 2000s, you actually see a flip-flop or reversal of this, right? We had a glut of labor when it comes to mechanics, HVAC technicians, you name it, right? Hands-on labor. And you had this whole, I'm in that generation, right? You had this whole, you got to go to school for a year or get your master's degree, blah, 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 this, that, and the other. Now we have a situation where we have a glut in those white collar skilled type of labor, and then we have actually a very big shortage when it comes to like the vocational type of labor workforce that is out there, which are making a significant amount of money right now. I think if you're an auto mechanic, you could do really, really well. So you have these ebbs and flows, and I think that's where we are at right now. I think you're also seeing the shift in tone when it comes to this, where you are now starting to hear a lot of younger individuals, those that are getting out of high school and saying, maybe I'm not going to go to college. Why am I going to spend 50, 60, 70, $80,000, $100,000 for a 4-year degree to go get a job that's going to pay me $45,000 to $50,000? When, my rent, if you're in certain areas, could be 50, 60% of your total take home pay, net pay, right? Which is something that it makes it very tight. So I think you're going to see this shift where we have individuals kind of going back out of that academic environment, looking more for the skilled trades and trying to, backfill some of these jobs. And artificial intelligence is going to eliminate some of the operational processes, but I am still of the belief that it's not going to go away, that you're going to have the human intervention. And that's just me. I'm a programmer and I love to program. But I've had a bunch of times where I program something that is not correct and it goes off the rails. And
AI can fix that, right?
Trust. AI can fix that, but AI can also mess that up as well. It's not perfect on the coding front, I can tell you that, but it could also mess it up. Here's a quick example, and I want to be very quick because I know we might be short on time here. But if you kind of just think about this, and I'm not really looking for you can opine on it.
No, I love it.
Right now, you have a situation where we have laws in the United States about fair lending practices, right? Equal lending, equal housing opportunities. And what that really is not trying to put one person in over another. It's just trying to say, hey, we can't discriminate against one population or subset over another, right? So we got to take some of those demographic metrics that are out. Because in the past, I'm not saying it's happening now, but in the past, we know from history that we have had certain individuals that were not able to buy and purchase real estate in a certain neighborhood or what have you, white, black, you name it, right?
Mm.
So, Stephen, let me tell you how, I don't want to say this is scary, but we have that framework that's in place right now. So when you apply for certain things, you don't have to put okay, I'm a female. Okay, well, maybe this person that's reviewing your application and your credit score or whatever says, you know what, you're a female, whatever. But here's the thing. If you model it out and you let artificial intelligence be able to dictate who gets lending for what, if you look at the demographic information and the data out there for different groups, say millennials, and to somebody that lives in a certain zip code and things of that nature, you have it actually model this out in a neural net type of environment, if you will, you can actually create its own biases without it actually being a bias, right? You can create it because the artificial intelligence is going to say, hey, this is I live in the 80104 zip code area, right? My demographic is 85% of my population is white, this, that, and the other. If I'm able to actually kind of throw some of that data in there, it could probably figure out with high degree of confidence who I am anyway, right? So you could actually have something that is a tool that can make.
But if you're overlaying the laws, though, it should correct those problems, correct?
It wouldn't. Because if you're kind of looking at the data set itself, you can still back yourself into those demographic norms. See what I'm saying? I could still tell if you give me enough data about yourself, you could make, you can't be 100% certain, but you can make a judgment or an estimate of, especially if you get your location data, like you say, hey, I live in this zip code. And you could literally back in to say, okay, this individual, this, that, and the other. The reason why I bring this up is because it's a unique use case, but it is something that you're still going to have human intervention to be able to do so, because you're going to still make a process so streamlined that it inevitably it will still actually discriminate against certain subset of groups. If you use it at a larger scale and you have the data set in order to do so. It's the same thing as the ads and the marketing that you get on, I don't want to say X because their algorithm is completely unique, but like, let's say Facebook or what have you, right? Facebook has always the right ads. They know I'm a fisherman. I'm always looking at, I always have a boat. I love football. I always got Bears coming up or purchase Broncos tickets. At some point in time, you got enough data, you can pinpoint an individual. Leveraging that for AI for certain things in the US might also get a little bit unique. So I think that's why you're still going to have somebody that oversees a lot of this stuff. And
I love this talk. And if you got 5 more minutes, I'm going to have to ask one more question. Yeah. Over the weekend, Elon Musk also mentioned pay for everybody. He wants I don't want to say it out loud because people will just take what we have to say, but he thinks that we should all get a base pay. He's changed his tune over the last 5 years, where he was a capitalist and now he's no longer a capitalist. Now he's saying that AI is moving so fast that maybe we just have pay based on who you are.
Yeah, universal basic income.
Basic income, but UBI, yeah.
Yeah. Yeah, I mean, look, everything is going to be dependent on the country itself. There are universal, UBI programs that are out there in certain countries, and it works. And in other ones, it does not work, right? It also depends on your population too. If you have a population of, say, like you have a small country of, let's say, 7 million people in your country, a little bit different than hundreds of millions of people in your country. Right. So it's going to be unique. I think that's a little bit more on his philanthropic side, I think, as well, right? He wants to be that guy that's able to create the technology where we don't have to put so much energy into building capital, and we can do more on the experiences of life. I think that's just his ultimate goal. Let's see if that ever, I don't think that's going to happen in my lifetime. And it will be unique. Steven, all I got to say though, is we've seen a lot of changes recently on how we do business here in the United States, just in general. So things are definitely evolving. And if people continue to support those, then that's probably the direction that we go. I mean, we are a democracy. I have faith in that. And we'll see how this all plays out. We've seen train wrecks in the past with this as well. Right. Soviet Union, we've seen complete train wrecks. So I don't have really any opinion on it. I just know that every country is different. You know, you can look at universal healthcare in some countries, works fine, no issues. And then others, it may not work so great. You know,
man, Kevin, I could talk to you all day long, man. I love picking your brain, especially on things that are not quite. It's, you know, you and I, we talk about the markets all day long, every day, and sometimes we got to get off topic a little bit because there are other influences and factors around what it is that we are looking at, right? It's not always about how much money the company made and what are they doing and what are they building. I think there's always factors around it that we don't always see. And I could pick your brain forever, Kevin. I know I got to run. I know you got to run. But Kevin Green, we'll see you right back here next week, man. I look forward to it.
Appreciate you having me on.
Thanks, man.